Hello, good morning. Thank you very much for attending PSG's last webinar of the year. I think a lot of you, like me, are actually looking forward to the festive season. Those of you that's going to be traveling, I hope you're going to travel safe. And over the holiday period that you're going to have a fantastic time with your family and friends. Today we're going to have two presenters, Lyle Sankar and Craig. Lyle has been with PSG for 7 years and have been instrumental in streamlining our fixed interest process. Lyle has been managing money for the last 3 years and is also the lead fund manager of the PSG Income as well as the PSG Diversified Income Funds. Our second presenter, Craig, she has been with PSG for 2 years and has 5 years industry experience. Anay is also heading up our credit research process, and in addition to that, she does research on property, equity, as well as corporate lending. I must say, if we're all looking back at 2020, we're definitely going to say it's really been a challenging environment. If we look at cash rates, it's on multi-decade lows. And if one think about the low yielding environment that we are in at this stage, one's really got to think about pensioners that's invested in cash or even money market. It's really got to be tough for them. But even within this environment, our fixed interest team are still finding excellent opportunities. So taking that into account, the first section of the presentation will be covered by Lyle. He's going to give us an overview in terms of the market and then especially where they're finding opportunities within the market. And there I've got to highlight risk as well, where it's a big focus in terms of risk and what we're trying to avoid from a risk perspective as well. Then the second part of the presentation, Anay is going to delve deeper into some areas of the market which we believe competitors are actually ignoring or avoiding, as well as other sectors of the market which we feel are totally overcrowded at this stage. Then finally, Lyle will do a wrap-up where he's going to take all this information and actually show us how he's constructing his final portfolio. Then just from a performance perspective, we're pleased with the performance that the different funds have managed to achieve compared to benchmark and peers since inception and over the last couple of years. What's more importantly from a performance perspective, it's exactly the same philosophy and process that's been implemented by the team over the last 7 years that have resulted in these performance numbers. As an example, the PSG Income Fund, as mentioned, it's been a tough 2020, and even within this environment, the fund have actually managed to provide our clients with excellent returns. And if one look at over the last 5 years, from a sector perspective, at the end of September, as well as at the end of October, the fund was actually top rated #1 in the specific category. Then if I just move on to the fixed interest sector of the PSG Diversified Income Fund, that's our flagship fixed interest fund. Currently, we really believe that the fund consists out of instruments that should provide our clients with extremely attractive opportunities. And patients and clients that's invested in the fund should actually be handsomely rewarded with good performance going forward. Then just before I'm going to hand over to Lyle, about 30 minutes once the presentation have actually stopped, you'll receive an email from PSG with a couple of CPD questions. We've applied for CPD points, and kindly just complete the online assessment when you receive the questionnaire in your inbox. I'd now like to hand over to Lyle, and once again, thanks a lot for attending today's presentation. Thank you.
Good morning, everybody, and thanks, Charles, for that lovely introduction. So I think, it's very important to us to engage with clients, and we really appreciate that, after a year of webinars, that you still take the time to hear our message, and we hope that it adds value and gives you some insight as to what we expect for clients over the next year. Obviously, we prefer face-to-face meetings, and we look forward, with 2 vaccines recently released, to some meetings and personal engagements in the year ahead. So the theme of the presentation, cash is dead. And I think, as Charles mentioned, cash rates are at all-time lows. And so when we're talking about yields in South Africa, when we look at recent years, we've always spoken to guys about the high yields in our market and the low yields in developed markets. But SA has now joined the party, and we are now running lower rates than we've run in the last 55 years. And this has been forced on us by COVID. And so when we look at the environment for fixed income, we believe it's not as simple as it's been in the past. And investors need to really consider how they approach their income instruments and how they approach risk in their portfolios. So what we'll do in the next few slides, we'll try and set the scene globally for what we're seeing as major influences on our markets. As we pause and look at what has been a very turbulent year, we can really sit back and say we believe the market is in a very unique position when it comes to the conditions that investors are facing, the positioning that clients have chosen, and the uncertainty as to where income returns are going to come from as we look ahead. So what is the market as we look at it today? What we believe is extreme market conditions and sentiment. So zooming out of South Africa, what are investors facing when they're looking at the conditions of global markets? So if you look at the global bond market, obviously very interestingly is that we're at 500-year lows in interest rates. When we spoke to you last year, we almost laughed at 10 trillion in assets yielding negative rates. That number has doubled this year due to COVID. During this year, which has probably been one of the toughest years in the market, and I'm sure many of the old hands that have dialed in today will agree that nobody would have expected junk bond yields in the US to reach record low yields and corporate bond yields to rally in the wake of COVID. And so when we look at the global bond market, we believe it's absolutely been distorted by central bank activity, and we think that the market is probably expecting this to continue into perpetuity. On the equity market side, the market is, global investors have found safety in the S&P, very crowded views in tech and growth, and very much the market's ignoring the value side of the market, and especially emerging market assets. As we stand today, the disparity in valuations in the equity markets is as wide as we've seen in decades. When we then go into emerging markets, we'll see that, in Q1 of 2020, we saw the lowest sentiment in history on record, and an exodus of flows out of emerging market assets. And so it's obviously been a very, very tough time for emerging market investors. But what we're obviously seeing is that as those flows continue, there has to be the assumption that low rates in the developed market continue forever, and high valuations in the equity market continue as well. So this type of fear that we're seeing in the market, where investors just don't know where safe returns can come from, has seen this trend perpetuate. And we believe that this view that hard currency denominated assets will continue to be safe haven assets despite this disparity in valuations and positioning is not appropriate at this point in time. So let's just zoom back into emerging market assets. And here we've got emerging market real yields on the long bonds. And you can see the impact of this outflow has been quite significant, with the vast majority of emerging markets offering significantly high real yields. And you can see South Africa tops the list, with the highest real yield having a real yield between 6 and 7% on the long bonds. If you look to the chart on the right, you can see the extreme currency weakness that we've seen of a basket of emerging markets over the last 3 years. And you can see something like Argentina saw 80% depreciation in their currency against the US dollar as money is flown into hard currency assets. South Africa, 20% deterioration in value of the rand. So what we're saying is that it's quite clear when you look at positioning, the market is choosing one side of the market where they feel it's quite safe, but the valuations are high or the yields are very low. And the other side of the market is wondering whether the next theme might begin to play out being counter-cyclical investing, value investing, or emerging markets becoming back in vogue. So I've got this picture on your screen, and it's a game called Botayoshi in Japan, where you've got two teams, one defending the flag and the other looking to bring down the flag. So this is very much what I believe. It's a bit of a funny example, but I think it's quite easy to overlay some of the dynamics in the market that we're seeing right now. So what we're seeing investors grapple with is obviously, will the status quo maintain? Is it actually just safer to just sit in hard currency, keep investing in tech stocks, and choose to invest in low developed market yields? Or is it time now to go on the offensive and look back to the areas where value is offering significant uplift? And so when you look at this game, you've got this big team of 75 surrounding this pole, and their job is to protect it. And on the other side, you've got this wave of attack that's coming across, looking to pull down that flag. And so if we bring that back to markets, I think you can compare what is known as the pole support and the ninja as the defense of this pole, and the status quo. So very well structured, looking to defend what is the current market conditions, what is the current market positioning. And on the other side, you've got this wave of attacks that is looking to disrupt what is the normal market sentiment at this point in time. So the 3 points that I want to bring out of this this picture is that if you watch this, it's quite hilarious. I would recommend giving it a watch in your free time in December. But the first part of it is that nobody actually knows what's going to happen in this game. It's quite chaotic, and the only thing that's very clear is that it erupts into chaos very quickly. And if you think about the market now, if you think about this bigger question that investors are grappling with, is that which theme will prevail next? And you see the signs of this move between let's go back to emerging market assets and let's go back to dollar assets as the year of uncertainty has unfolded. The second point that I want to bring across is that if you start watching this, you look at the team defending, very well structured. It appears very obvious in the beginning that it's destined for them to win, because you've got these individuals that are trying to break down this very well-defined system. And that, in a way, also is very similar to what investors are saying now. They're sitting back, looking at the high valuations, but saying it's probably likely to continue into perpetuity, just given how well-structured things are. And, a few things have gone very well this year. And then the last point, and when you're watching this, give it a look, what you see is that at no point during this game you get the feeling that one team has taken the lead. And at some point, an inflection point happens, and either defense or the attacking team takes the lead. Now, similarly in markets, there is not going to be a signal that's going to tell us that emerging market assets are back in vogue, or it's time now to look at to focus more on valuations rather than the growth and the crowded trade in the market. So if we look at then what's happening in South Africa, it's not hard to say that it's the same transition or rotation has happened in recent years in SA. So the same extreme conditions and positioning is something that we've seen locally. As guys have feared equity, multi-asset, we've seen flows move into cash and income type funds, and especially in income type funds on the shorter end. So when we look at SA now, as I mentioned, SA repo rate at 55-year lows, business confidence in SA 40-year lows. If you look at pension fund holdings of domestic equity, lowest since 1980s, and we've seen 356 billion rand move into income funds over the past 2 years. So what's significant about that, as an income fund manager, is that this rotation, while it may have been favorable in recent years, we are now at a very late point in the interest rate cycle where rates have been cut by 3% already, and the flows have moved into funds which have chosen to favor the short end of the market rather than longer dated bonds being your sovereign bonds. So what we actually have over here is you've got this broader market distortion, global market distortion that has flown into SA, and SA investors have chosen to do similarly, move offshore, move into cash, and take on rand edge exposure. So we believe we have a very distorted fixed income space, an array of assets that are available to fixed income funds, but not appropriately priced, and we've got an area of the curve being the sovereign curve where the market is seen to price higher risk than we believe is prevalent. So obviously, I think these are the questions that one would ask. The environment is quite uncertain. I've shown you very many reasons to believe, that potentially, investors might just opt to sit in cash. And I think what's important is rates have been cut by 3% this year. Cash as an asset class or safe place is dead as a means to generate income. And so what can investors expect? Can they still produce decent income returns for their clients? Are there risks that you need to consider? And then how will we go ahead from this point to generate satisfactory income for clients? So we look at what the fixed income market looks at right now and 2 years ago at the end of 2019. As you can see by the light bar, it wasn't very hard to generate inflation-beating returns, and even in cash you could earn almost 7%. But as we mentioned now, rates have been cut by 3%, and the flow of investors from higher risk funds into income funds, and especially funds predominantly invested in the short end of the market, has seen rates fall significantly on the front end of the curve. So cash is going to give you between 3 and 3.5% over the next year. I doubt that meets anybody's income requirements. Similarly, money market will follow suit. And we look at NCDs, bank funding, and corporate bonds, so corporate lending, these rates are almost 4% lower. If you look at corporate bonds specifically, 75% of that market is floating rate notes. So that means, as of the last rate cut, 3% lower yields are immediately in the opportunity set for corporate lending. So we think the distortion is quite clear when you look at this. Is you ask yourself, why is the front end of these rates in corporates, banks, in money market funds and cash rates fallen, but nominal bonds and inflation-linked government bonds have not really adjusted? So we think, if you look at this holistically, it's quite clear in the front end, in the red box, that clients aren't going to do very well over the next year. It's very unlikely that you earn good returns. And so what we are seeing is clients saying to us, why would we bother with nominal bonds or inflation-linked government bonds? It just doesn't seem worth it at this point in time. We believe the risk is actually in the opposite, is that we think if you do forgo this opportunity, you're almost destined to underperform for your clients. So what I'll do in the next section is just give a bit of insight as to how we're thinking about the sovereign bond market, what these global trends are inferring for our bond market, answer, or at least try to answer the question about why it's opportune to move out of cash, and try to give a bit of context as to what investors are leaving on the table if they continue to sit in cash, wait for things to get better. And then we'll talk about a what-if scenario with which we believe the market's not really, considering at this point in time. So I'll start with, the realities of the fiscal position. I think, if you read the quote on the slide, the fiscal position is one of the central impediments to economic growth. A failure to reverse present trends would inevitably result in a debt crisis. So this is from the medium-term budget policy statement. And, obviously it's quite realistic as to, what the situation is now. So if we look across the way, it's obviously that, it's obvious to see that most emerging markets would have suffered this year. And the situation isn't too dissimilar to South Africa's debt concern. But nevertheless, for us as South Africans, as investors in South Africa, it's quite worrying. We entered the year in a fragile position at 63% debt to GDP. We've taken a massive jump in 20% debt to GDP. And so, with an 8.7% contraction in GDP expected for this year, debt is expected to peak now in 2025 at 95% of debt to GDP. So when we look at it, government has now put forward a 5-year consolidation plan. In October, or in the supplementary budget, they had recommended a 3-year consolidation plan. We believe this is obviously a bit more reasonable. But what they have put on the table is 300 billion in cost cuts, or at least not cutting costs, but slowing the growth rate in the biggest part of the expenditure or non-interest expenditure being the wage bill, and then making a reallocation from departmental budgets to drive spend in infrastructure and real GDP potential. So obviously when we look at this, the question is, that we see often is, and we've actually tried to answer this for many years for clients, is implementation. South Africa has never been able to adjust the wage bill. It's never been able to drive expenditure. It's never been able to drive expenditure for growth. And the markets have even posed the view that 300 billion isn't enough. So when we look at it, I think when we look at recent history, there's a lot of evidence that says, policy implementation isn't South Africa's strongest suit. And so when investors look at this, they ask the question, is this just too much risk? Is a debt crisis around the corner? And are we going to default? Will I not get paid my interest rate or coupons? And so when we look at it, we think, the question of is it just not worth it is a reasonable question. But if everybody has this consensual view, it becomes, sorry, just give me 2 seconds. Is that better, guys? Yeah. So if everybody has this consensual view, it is likely that when we look at bond yields, it's quite clear to see that a debt trap concern, being a consensual view, results in a bond curve that looks like this. So the bond curve is simply rates from the very short end at cash being 3.5% to our 30-year bond at almost 11 and a bit percent. So when you look at this and you ask yourself, if the view is already, determined that South Africa will enter a debt trap, you've seen unprecedented SA bond outflows, and you've seen extreme currency weakness, what do you get as a bond curve? And we think the question to ask is, what kind of opportunity does that offer? So South Africa now has the steepest bond curve in South Africa's history. So the highest premium for long-term funding over short-term funding rates. South Africa's bond curve has the largest premium in our history to US bond yields. So the difference between our bond yield and the US bond yields is normally indicative of the risk premium investors require to invest in South Africa. And that is by far the highest it's been in history. We've also, when we look at the emerging market basket, despite the disruption that we've seen across emerging markets, South Africa has the highest credit risk spread as well in that basket. And then obviously, as I've shown in the previous slide, South Africa does have the highest real yields globally. And so what is important over here is then to ask, how can we benefit from this? If the market's already concluded that this is a difficult situation, how difficult, how can we benefit from this? And then what we try to do is also try to contextualize what the situation actually is in South Africa. So as I mentioned, funding rates in the whole system has dropped significantly. The repo rate is now 3% lower. So what I have on this graph from left to right is just the simple funding system, the flow of money in South Africa. So if you start on the left-hand side, the South African Reserve Bank lends money to our banks at 3.5% now for up to 12-month funding. The banks can now lend money to individuals around 7.5%. Remember, prime used to be 10.5% a year ago. It's now around 7.5%. And investors, individuals on the street are willing to give their money to the banks between 0 and 6%, depending on the term. The investor community, as I explained on the corporate bond yields being much lower now, are willing to lend funding to the banks at 4.5%. And so when you look at it, most of the market reflects the fact that funding is now a lot cheaper in the market. But when we look at government is required to pay between 9 to 12% for funding in a market where banks are able to lend at 4.5%. So this is the dynamic of a steep yield curve, is that short-end funding is very cheap and government's paying a lot of money to get the funding that they need. So how do we benefit from this? And I think it's a scenario worth considering. In a high yield scenario, often the question that we get is, I can sit in cash at 3.5% and move further out on the curve, but isn't it just taking a lot more risk, and is it worth it? And so when we look at it, this is a simplified version of the bond yield curve. So every 5 years where the yield is, And so we try and use this example to answer the question, is it worth moving out of cash? So the expectation from investors is that you aren't going to get your coupons, government is going to default, we don't believe we'll get our money back. So when we look at this curve, we say we think it's different. We don't think a debt trap or a default is imminent or even something you need to consider in the next 3 years. And so there is a massive opportunity cost for sitting in cash. And so when we look at it, the green bars over here show you the premium uplift, or premium or uplift in yield that you get for moving out of cash. So sitting in cash, moving to the 5-year bond, you get almost 2.5 to 3% additional yield. Then moving further to the 10-year point, on top of that 2.5, 3% yield, you get an additional 3%. So simply going from cash to the 10-year bond offers you almost 6% additional yield, and at the 15-year point, you're getting almost 7.5% in yield higher than sitting in cash. So that alone, if you think about it, over the next year, if we don't believe government is going to default, then that's what you're giving up in earnings for your client. But when we think about a steep yield curve, there's a lot more behind it that investors don't really understand, that both enhances returns as well as de-risks some of the potential for yields to move against you. And so if we look at the bond curve, as a 10-year bond becomes a 9-year bond and a 5-year bond becomes a 4-year bond, so let's just sit and wait for things to get better. If it doesn't get better, we earn the yield. But over the next year, the bond yield must come down. So if you look at the steepness from moving from cash to 10 years, there's almost 0.5% for every year that you move down the curve. So just by sitting here, that 10-year bond yield is going to become a year shorter in a year's time, and it's going to offer you 0.5% of compression, which actually, when you look at the green bars, adds almost another 4 to 10% in returns relative to cash. So you're not just earning the yield, or let's say you're not just foregoing the yield if you sit in cash, you're also foregoing this benefit that is presented with a steep yield curve. And for us, we think there is a scenario where things don't get much better. Often with government, we've got to take a longer term view, and over the short term, the reality is that you can actually pass begin and earn your 200 consistently, and that has been the case in South Africa's history since we've had a bond market. So what we'll do on the next slide is just consider what about a scenario where South Africa gets 1 or 2 things right? Not everything, 1 or 2 things right. Is this something that investors are even thinking about? So we've explained to you that we believe the curve is probably reflecting that a debt trap is certain. We believe there's exceptional returns in a muddle through scenario. But let's just talk about the what if scenario. So the first graph is from 1993. The SARB wrote a paper about South Africa's risk of a debt trap, and they projected non-interest expenditure similar to what we're seeing now to grow into perpetuity. And so at that point, South Africa was in a very difficult time, going through a transition, and there was a lot of uncertainty. But that was the picture then. And I think it would have been very hard, if you were there in that market, to believe that South Africa would have avoided a debt trap back then. But there is a hard-fought solution that requires obviously cost cutting, something that we're seeing now, improved private sector sentiment, economic growth, confidence, both local and offshore. Offshore we don't have control of, which can ultimately result in lower interest costs, which can erode this debt burden very quickly. And this is what happened in the early 2000s. And obviously we were aided by a very strong commodity cycle, and South Africa actually, produced budget surpluses in the early 2000s. So, we think, the market has got an expectation that it is, it's absolutely unavoidable at this point in time. We don't believe that's the case. So when you look at this, I think, as we mentioned, South Africa's earmarked 300 billion in cost cuts, and that does seem like a very steep number, especially how sticky unions have been. They've also then targeted infrastructure spend to, eventually achieve higher growth potential in the long term. And so when we look at it, everybody identifies that as implementation risks, with the 300 billion being top of mind. It's the gauge that we think the market will evaluate our progress towards relieving the debt burden. So what we have over here is two scenarios. The first being the gray line, the top line, and this is where we achieve no long-term GDP growth, 0%. The economy doesn't grow above inflation, but we achieve 300 million in cost cutting as government mentions. And you can see the line does grow into perpetuity. The second scenario, the blue line, is where South Africa actually generates 2.5% long-term growth. That is, historically South Africa's growth potential, but we achieve 0 in cost cutting. So come February, everybody looks at the budget and we say government's failed again. But what you can see is a very clear difference in the debt path. And what's quite clear is that while we do need the cost cutting, and everybody will benchmark our success against 300 billion, what's important is we actually need to drive sentiment and confidence in order to drive longer term growth. And you can see that growth is actually the more valuable tool over the longer term. So you may ask, seems very hypothetical. Has this, where's the evidence for this? And Brazil, is a very clear case study. So we often ask ourselves, why are our yields higher than Brazil's? Their debt is higher than ours. The situation doesn't seem better in Brazil. And so we decided to invert that question to us, maybe our yields should be higher than Brazil's at present. And so when we look back over the last few years, Brazil got relegated to junk status in 2015. That was actually the point where the yields peaked. They then made changes to their president. They had a lot of corruption going on, and they made changes there. They then, adopted a spending ceiling and introduced reforms into the market. And what you can see is, at that inflection point, when Brazil made these changes, pessimism was at its highest, and the yields were at its highest. Brazil was actually in a normal cycle recession, not a COVID-induced recession, a normal cycle recession. Their debt to GDP was well within the range where the IMF starts flagging as a risk. The inflation at that point in time was almost 9%. And so the starting point wasn't actually great, but subsequently, having implemented the reforms, driving confidence higher, and improving sentiment, Brazil's bond yields have rallied almost 10% since the peak in yields. And so for us, it's quite clear that yes, the cost cutting will matter, but what will move the needle and what will drive, erosion of that debt burden is, creating a business-friendly environment, and that's something that South Africa has to focus on. So when we look at it, we're not sitting here saying that, it isn't a challenging and uncertain environment, but we do believe that incremental improvement to South Africa's path isn't impossible. So yes, South Africa has been at the epicenter of this. When you look at real yields, South Africa's real yields are the highest in the world. These are very uncertain times, and we all are concerned about the impact of our the lockdowns on the economy, especially that the fiscal position is quite fragile at present. We also sit here and it's quite irritating that government doesn't move on critical policies. And history says that the ANC doesn't generally choose the easiest route. But what we believe is not the appropriate way to approach this market is to apply a zero probability that South Africa can enact critical policy to drive growth. So we think the view is quite extreme to assume that there's no chance of success. But what we do acknowledge is that in these challenging and uncertain times, South Africa does have one of the cheapest markets, and specifically the bond market. So what does get less attention? What are these reforms that Brazil implemented, and what's the things that South Africa has done that's getting ignored? So, interest rates and funding is at long-term lows, and inflation is very low. This is very much business positive, and we think South Africa's terms of trade has been improving. So oil prices low, the rand is weak, commodity prices have been adding that benefit, and we've actually seen 6 months of a trade surplus, despite the economy operating closer to full capacity in most sectors. Then you ask, from an institutional strength perspective, so reforming your institutions, most of us would have said 3 years ago, if you gave us Edward Kieswetter, the new leadership at the Hawks, the new leadership at the NPA, Cyril Ramaphosa as opposed to, the Jacob Zuma era, I think we all would have taken it, but we all don't give it enough credit. And then obviously, Andre de Ruyter being, in charge of Eskom now as opposed to the previous regime. Also, what's quite important is the private sector is actually playing a massive role right now that's just happening in the background. So, Martin Kingston, our head of business for South Africa, when engaging with them, this plan that you've seen by Cyril Ramaphosa is actually the plan that they produced. And, in their view, this is the closest they've ever been to government. And so these are positive things that just does not get attention. We've also, when you're looking abroad now, we've also hit close to peak COVID infections, and infections are quite sporadic at this point in time. And so, this tends to coincide with the bottom of confidence. And what is also being forgotten is, are foreigners always going to stay out of SS market? Recently, we've seen foreigners return to both primary bond market auctions and the secondary market, which is quite positive given where valuations are. And so if you look at this, if you ignore, the positive things that could drive the bigger driver of, fixing our debt problem being growth, there is a very big opportunity cost. And you can see over the last year, bonds returned almost 7.3% returns annualized. And so I'll leave it with a quote from the president in the business day last week, is all I want as president is implementation. I tell my colleagues, do not come to me about stories and problems. I only want to hear about implementation. And I think these are important things to keep monitoring, apply an evidence-based framework, but clearly there is still quite a bit of value in sovereign bonds. So on the next section, I'll hand over to Ane, but just to emphasize that, we do believe for income fund investors, there's still a very attractive opportunity in sovereign bonds, but we do believe that rates as a whole has come down, and so returns for income fund investors should be lower going forward. But we, through these market distortions, as Ane will talk through, there are opportunities to bridge that gap for income fund investors that have a slightly longer term. And so, thank you for your time. I'll hand over to Ane.
Thank you, Lyle. Good morning, everyone. We're now going to take a look at the other assets that we have in our multi-asset fixed income toolkit and how market distortions have created opportunities in these asset classes, but also risks. In particular, we'll look at dislocation in property prices and preference shares, where there are signs of overly negative pricing. But first, we start with the market for corporate credit, an asset class very common to multi-asset fixed income funds, and one which we feel is currently quite expensive. Corporate credit is a broad term for any bond that's not a government bond. So what you see on your screen there are two curves, the black one representing the yield on a government bond and the gold one representing a yield on a corporate bond. Now these yield curves are a lot flatter than the ones Lyle showed you, and that's because this is the return that you can expect on a 3-year bond only over the period that you see on your screen there, November 2016 to Feb this year before the crisis. So what a yield curve is of course a return on your investment when you're from the investor point of view, but what it is for the issuer is their cost of borrowing. So what you see on your screen in the black is the cost for the government to borrow through a 3-year bond, and the gold is the cost for a corporate to borrow. The difference in the cost of borrowing between that risk-free curve and the credit curve is credit risk. And that's the credit risk premium that investors demand to incentivize them to move away from the risk-free curve and into corporate credit. It's the compensation that they need for that risk of a credit event, the worst of which is default. So that's the risk of not getting your money back. We've used banks as a proxy for the credit curve there, and they're of quite high quality. So you'll see that the credit risk premium that markets typically demand is about 1%. 1% above that risk-free curve. And this is a normal market. This is the textbook answer. But of course, COVID hasn't been normal, and it's led to market distortions. What's happened since the March sell-off is that credit spread that investors typically demand, that 1%, has actually turned negative. So now, as Lyle alluded to earlier, it's cheaper for companies that do business in South Africa to borrow than it is for the government of South Africa. what's going on. The market is saying that there's a very high bar to invest in government bonds for all of the reasons that Lyle spoke to. But it's also saying that investors are very comfortable taking on credit risk, but receiving a much lower return on their investment than they did a year ago. This is quite strange if you think of the tough challenges that companies are facing today versus a year ago. Credit quality is typically worse. So is the market saying that corporates are immune to their operating environment, the same environment that the government is operating in? See, pricing credit correctly is very important because there's no upside in credit. If you invest in a bond, you get the yield if you hold it until maturity, or you get less if there's a credit event. So what the market has been forgetting since mid-March is that local currency sovereign bond defaults are quite rare, whereas corporate bond defaults are just part and parcel of a recession. In fact, 14.5% of US high-yield bonds defaulted in the previous financial crisis. Yet, corporate credit in South Africa is pricing as if it's risk-free. We don't agree with this market distortion. We are therefore not constructive on corporate credit, and long-term investors of our funds would therefore not find it surprising that PSG's allocation to credit is at the lowest point in our history. When we do invest in credit, however, we have multiple entry points that we can choose from. So we assess the risk and then we allocate capital accordingly. So we just spoke about corporate credit, which is a general catch-all for things like senior debt and subordinated debt. You would have heard these terms before around banks, which are typically the issuers of these instruments. We can also invest in preference shares. They are that hybrid asset class that a lot of you will be very familiar with. It's not quite credit and it's not quite equity, which is another asset class that our diversified income fund typically has a small allocation to. What you see in front of you there is the capital stack. So how the capital stack works is like a line of investors queuing to receive their money. So the investor in front of the queue is the holder of senior debt and has the first right to get their money back. The ordinary shareholder, the equity holder, stands right in the back of the queue, with sub-debt and preference shareholders somewhere in the middle. So what's quite interesting is that, of course, as you willingly agree to stand further back in the queue, investors will require an incrementally higher return for standing further back. So now what's quite interesting is that there are instruments that fall within that subordinated debt category that are very similar to preference shares. They have discretionary, non-cumulative coupons or dividends, and they sit between that senior debt and equity stack. Yet the market's loving sub-debt, but the preference share market has been a bit neglected in years. Okay, so we've said to willingly stand further back in the queue, investors require a pickup over that senior debt, that senior bond yield. And typically, this pickup has been about 2%. That wasn't really very compelling to us. But we know that the COVID crisis has led to market distortions, and in this case, a severe sell-off in preference shares. And this is because investors became highly concerned that banks wouldn't pay their preference share dividends. So that yield differential above senior bonds spiked from 2% to over 8%. And the outright yield on the preference share index today is over 12%. That's an equity-like return for something that is a lot less risky and which ranks ahead of equity if we think back to that capital stack on the previous slide. So for investors that did their homework and assessed the risk of banks not paying their preference share dividends to be quite low, this presented a very compelling opportunity to enter the preference share market in a sensible manner. And so far, the investment thesis has played out. Banks have paid their preference share dividends on time. So this is evidence, again, of market distortion and how the market was overly concerned with the risk of those dividends not being paid. Market distortions create opportunities, and this one presented one where investors could find attractive yields if they were willing to take advantage of the market's fears. So far we've looked at markets that used to be normal before COVID, and then COVID led to this market distortion. But we think that before listed property became South Africa's most hated asset class, the market was actually not paying attention to distortions within the property company's earnings and their balance sheets. The market has since acknowledged that dividend growth was relentlessly pursued and earnings propped up by things like financial engineering through really complex stuff like cross-currency interest rate swaps, and some more simpler things like recognizing and paying out income from BEE schemes that were only ever set up to survive bull markets. We also saw non-recurring income as a standard feature of dividend growth earlier on in this decade. And then, of course, the most dangerous of these factors, leverage, which was used to increase those dividend growth yields. And this has led to unsustainable capital structures. So during the second half of 2008, it became very evident that organic growth prospects in the sector were low, and that these inorganic earning sources were not sustainable. And we know that investors paid dearly for not seeing the risks that were building up in the sector. And of course, these risks that were building up in the sector meant that property companies were vulnerable at the start of this crisis, and they were never likely to come out on the other side unscathed. So if a property market was wrong then, and it was ignoring all of those risks, is it right now? We know that the all-share index sold off significantly in March, April, and that it's regained a bit of ground since. So is the Rand. The Rand's a really good proxy for how people feel about South Africa, that SA Inc. investment. But the South African property index sold off significantly more, and it hasn't recovered. Sentiment has stayed decidedly negative. Investors are pricing in things like restaurant and movie closures into perpetuity, and they're relegating offices to the endangered species list. This led to property being the worst performing asset class over most short and long-term periods. But what does it mean for the future? Is all this bad news priced in now? Let's have a look. So this is quite a simple chart that tells you how the market values property and what they're willing to pay for the physical bricks and mortar, less the debt that the companies had to take on to acquire these assets. So we see that before the global financial crisis, it peaked at 1.6 times. That means investors were willing to pay 60% more than the physical assets were worth. Of course, they learned a hard lesson during the GFC, when in South Africa, property started trading at a 30% discount to the value of physical assets. And that lesson was soon forgotten, because as late as 2016, we still saw lofty premiums of 40 to 50% in the local market. But now the market is saying this time is different, those dangerous words. It's worse than before. And it is. So we're not disputing that this recession hurts. It is worse than the GFC. We're also not disputing structural risks to the property sector, like online retail, for example. Bet you some of you are quite bored and are shopping online right now. We're also not disputing the convenience of working from home. But what the market is saying is that 50% of South African assets, if you look at that black line on your screen, 50% of value will disappear. That's after property managers have written off their assets 5 to 15%. They've impaired those assets by up to 15% this year. Okay, so let's think about that. Half of all property values in South Africa being wiped out. Think of half of all offices, value gone. It's tough to see, but maybe. Now think of half of all shopping centers, all neighborhood convenience centers, half of all warehouses, half of all distribution centers, gone, wiped out permanently. Probably not. To show you how negative the market is about domestic property, we have a look at Growthpoint. So you know that Growthpoint's gone overseas in recent years, and it's invested in the UK, Australia, Poland, and Romania. And those investments are all listed. So we know what the market thinks about those investments and how they value those assets. In terms of Growthpoint share price, that equates to about R8.50. Now, most of you have been to or seen the waterfront here in Cape Town. It's beautiful, it's a great asset. But of course, it's not immune to those structural headwinds, and it's probably going to take a while for tourists to come back to our shores. So let's be conservative and cut this year's value by 20%, That adds another £2.50 to the growth point share price. If we compare that then to the actual share price, and these were all at 30 September, what it implies is that the market is valuing the South African portfolio of South African assets at zero, nothing. And that compares to over R9 of NAV, of net asset value, as per their June financials. So what are we getting for free? Let's just think about this. A shiny new Discovery head office in Sandton, Pall Mall in the Western Cape, free. Warmer Park in Port Elizabeth, free. Or any of their 68 distribution centers and 34 warehouses catering to your online retail needs for free. We've gone from being very cautious of property in the past to being cautiously optimistic. The market distortions that we've seen just now have created fertile ground for our 3M process, where we can take a long-term approach, we can sift through the noise, and focus on particular areas of the market where we can find inherent quality that is being mispriced by a market that has a short-term view. To summarize these views, I hope that Lyle's convinced you that cash is dead. And if we look at the other classes in terms of how we construct our fixed income portfolios, credit's not quite dead, but it is pricing through the sovereign, and the market is ignoring the risks inherent to the asset class. That's a market distortion we're not comfortable with, and a risk we're not willing to take for our funds with low risk mandates. Our most attractive opportunity still lies in the sovereign, in both inflation-linked and nominal government bonds. And that's because extreme bearish sentiment have created the most attractive real yields in the world. The distorted preference share market has seen prices decimated, and that provided an attractive entry point for us to gain exposure in a sensible manner. And through property cycles, we've learned that it hurts to be blind to distortions, both on the downside and when prices are so low that investors must ask themselves if the market is nearing an inflection point. Lyle will now conclude on how we are using these views to construct portfolios that can still generate attractive yields in a low-income environment. Thanks, Lyle.
Thank you, Renee. So in the next section, I'll spend some time just looking at our propositions from a fixed income perspective. I think, when we start, it's quite important to take a step back, just look at what the cycle has been. And on this graph, I've got, cash rates, the argument that cash is dead. You can see cash is close to 3%, 3.5% now. And I've got the benchmark of income funds being the black line. And you can see post-rate cutting cycles, income funds still outperform cash for quite some time, and we think there's no reason to believe this cycle is different. We do, however, believe that if you are invested in the very short end of fixed income assets, then you're probably less likely to outperform cash at the right level of risk going forward. So I'll start with the PSG Income Fund. Charles has introed the fund in the beginning, and I think this fund, just to emphasize that it is a pure local fixed income fund. It's a duration limited fund. Capital preservation is at heart for this portfolio, and the idea is that what we want to do, and especially in tough years as we've done this year, is outperform cash at low levels of risk. And so when we look at the portfolio construction in recent years, you would have seen a lot more credit in the portfolios. You would have seen a lot more NCDs being bank funding, and those instruments have worked very well for the portfolio. But consistently seeking to obtain or buy real yields into our portfolios, as our process does, has led us to exiting some of those positions and migrating to the areas of the market where we believe it's quite cheap, being nominal bonds, inflation-linked bonds, and with a balance of floating rate exposure in order to construct a balanced portfolio. You may ask that there's quite a bit of inflation-linked bonds, and we didn't really touch on that. But similarly, and I think Renee touched on it, is that as the real yields in the nominal bond market has been high, our real yields in inflation-linked bonds have been exceptionally high as well. And so within that exposure, we've got a very large exposure to a bond that is 1.4 years to maturity. And for us, it is a bond that's offering both a real yield, both inflation protection, and it's quite short short-dated in nature. But what we can see from that bond is that we expect it to outperform credit, outperform money market instruments, and definitely outperform cash over the next year. And so we think it's an attractive liquid area to be invested in. The fund obviously remains quite liquid, and we think it's quite a scalable product. So from that perspective, I think, we think it's quite attractively positioned within the local fixed income space. We think being positioned closer to the sovereign curve, in the right areas of the curve, being that belly of the curve, or the 10-year point, as I showed you, offers immense value. And we think, when you're looking at the cycle, sitting in cash, this is just a better alternative to keep up with client returns. The next fund I'll take you through is the PSG Diversified Income Fund. This is a multi-asset flexible income fund. And so when you look at it, it's a fund that doesn't have a duration limit. It can invest a bit longer as a result, and it does have access to the assets that Renee pointed out. You want to be buying equities, preference shares, and property when they're very cheap. And we think, we've been presented with these kind of opportunities now to supplement a fixed income view that's predominantly in the sovereign bond market. So what we think, is the benefit for this fund is that, while income funds and cash will trend lower, given the shorter duration of these funds, this fund then can add or bridge that gap to, the income returns that clients, were used to in recent years. And we think, there's quite a lot of embedded value in the portfolio with the ability to, to access offshore markets as we have done in the portfolio. So what I'll do is I'll conclude. We firmly believe cash is dead. We don't believe it's the right time to sit in cash now. There's a massive opportunity cost. There's a lot of yield on the table. If you're willing to take a longer term view, we think there's attractive uplift for clients. We think the sovereign bond market is the place to invest your clients' cash. We think that other areas of the market will, introduce higher risk, but also almost make certain that you would underperform versus CPI or the benchmark. And then we think investors just need to take a step back and consider the risks that are embedded in their fixed income exposures. As we've mentioned, not all is equal anymore. It's not as easy as it was in the past. And then we think investors need to consider whether we are overpricing the risk in the sovereign while we're waiting for things to improve. So from a market distortion perspective, we think there are additional tools that prudent investors can access. As I mentioned, in the Diversified Income Fund, we can access the attractive high-quality mispriced assets being preference shares, a basket of equities, and property. These both improve your risk-adjusted return profile, and it will assist in bridging the gap for clients that can take a slightly longer-term view, with more towards a 2-year time frame. So the outlook, in aggregate for income-seeking investors still remains attractive. We just think investors need to consider whether they're allocating their risk budgets appropriately. So we'll take a few questions and let's see if anything's come through the chat.
While they're getting that up, Lyle, I saw a question before I came on stage around the execution risk that the government is facing around that 300 billion in budget cuts. And the question was framed around whether these expenditure cuts are likely, and whether we can actually back government to do so given their track record and the inefficient spend that they've had before. Also making the point that lower growth is not necessarily a cut to a budget, but it's a cut to a budget set in the future as opposed to expenditure cuts this year. So I think just to reiterate what you said before, maybe just to highlight for our viewers again, what's more important in your view? Is it expenditure cuts and the execution on that? Is it necessary, or is it actually growth?
Yeah, I think it's a very pertinent question. I think that's probably what most of the market is concerned about now, is that 300 billion mostly allocated to the wage bill seems just impossible, given that governments always had the stance that they'd give in to the unions. And I think this time there is a bit of a realization on both sides, is that from the union's perspective is that without cutting this let's call it forward expenditure by as much as they can, there will be jobs lost on the one side, And then from government's perspective, I think, they've taken the hardest stance, which is, potentially not, not necessarily what we want to see. We'd like to obviously see, more engagement between unions and government. So the 300 billion itself, I think, anybody can guess what's the exact number they'll achieve in that range. But as we mentioned, in the presentation, it's actually more important what they signal with their cost cutting and what that means for growth. I think South Africa is at a point where cutting jobs or firing people isn't also the solution with our unemployment rate. So I think what we can see from the market is that the market's almost giving it a zero probability of any success. And what it will be deemed a success? Would it be 250 billion or 300 billion? We certainly would like to see 300 billion, and that would be a very good signal for growth and sentiment.
Okay, makes sense. Well, I'll read the questions that I see because they directed at you, luckily. What's your view on the rand?
I think I'll give that one to you. No, I'm just kidding. PSG, we don't, as a part of our process, forecast macro variables, and especially something like the rand. I think, we've had the view that the rand has been weak just relative to, valuations. And, the trend has obviously been upwards in the rand dollar exchange rate. But we certainly don't want to forecast. What we can obviously acknowledge is that when you look at these valuations, the rand is quite far in the left side in terms of where it probably should be on a purchasing power parity basis. I see there's another question. What's the projected yield on the PSG income fund going forward? Again, obviously, please don't hold me to this, but I think as a running yield, the fund is between 5.5% and 6%. I do think, as I mentioned in the presentation, achieving the 10% returns that we have in the past is going to be obviously a lot harder, if not very difficult. And so I think the fund obviously as a base can earn, clients a very good yield of almost 3% above cash. And then, if a few things go slightly right in the positioning in, nominal bonds, sovereign bonds, the, exposure that we still have to corporate bonds are still priced quite cheaply. The fund can do, quite a bit more than that. So I don't want to give you a definite number, but I think there are there's still quite a good opportunity for investors in cash.
I don't see any other questions on our screen, and I do see on our monitor that our time is up. So if your question hasn't come through, please reach out to your fund specialist and we'll make sure to get an answer to you shortly. I think, Lyle, that's us.
Yeah, thank you very much again for your time, and we really appreciate it, and have a good day. Stay safe. Cheers.
Thank you all. Thank you.